Hello there. Welcome to Financial Accounting Info. In this video, we want to look at the preparation of income statement, and that is a statement of comprehensive income. So we've got a question that we have here, which is now question 3. So we can go through the question. The question is we are provided with the pre-adjustment trial balance of new fashion designers, together with adjustment to be made for the financial period which ended on 20th February 2014. So on the required part 3.1, it reads draw up the income statement for the year ended 28th February 2014. So we are going to look at question 3.1 in particular, according to this video. So we go to the other information that are given in the question and try to see what we have. So if you go there, you would see that we have got a pre-adjustment at share balance as a 2014, which you need also to go through before you start to answer the question. So this is what we have. Then going to the next question, next page, you'd see that we are given again additional information, that is adjustments and additional information on information B, ranging from information 1 going down to information 10. So you also need to go through this information before you start to answer the question. So going back to our answer section, you would see that we have our new fashion designers income statement for the year ended 20th February 2014. So this is our answer section. Obviously, other section, we are going to start with the figure for sales. And obviously, we need to calculate the turnover or the net sales figure, whereby we are going to say our sales, total sales figure that are given in the pre-adjustment trial balance, and then try to see if there are any data allowances or sales returns that are there in the question that we need to subtract from the sales figure to get the net sales figure or the turnover. So we go to see according to the information given, what information do we have in terms of our sales. You come here, you'd see that we have got our sales, and then the figure that we have is that 945,000 representing our sales. So this is what we have, and then having our sales as 945,000, we check if you've got any returns in terms of data allowances or sales returns. But if you come here, you see that we've got our data allowance with a figure of 8,050. So you need to subtract 8,050. So having discovered our data allowance, also need to go into additional information to try to see if we've got any information that is affecting our sales figure, be it our sales returns, so that we can arrive at the figure of net sales. So if you go through the additional information, see that we've got nothing to do with adjustments that are affecting our sales or sales returns. So we are just going to give a calculation of saying our sales minus our data allowances, which is 945,000 minus 8,050, and we get the net figure. So we go there and just indicate that calculation, whereby we are saying in brackets, we have our 945,000, and then we subtract our 8,050. Right, calculating like that, I see that the figure that I'm going to get as our answer is 936,950. 936,950. So after that, now we need to check for the figure for cost of sales. So here we have got our cost of sales, of which we are going to subtract our cost of sales. So we go there and check in the list of balances the figure that we have cost of sales. So we are here, you see that the figure that is being indicated there is our cost of sales. We have it here, and the figure that we have is 150,600. So obviously, you also have to go through the additional information to see if there's any adjustment that is affecting your cost of sales. So according to this question, we do not have any in the additional information. So we're going to check 150,600 as it is, and indicate it as our cost of sales. So we come here, we indicate it as 150,000. 150,600. And remember, we subtract it from the figure that we have for sales to get the figure for our gross profit. So the figure that we are going to get here becomes our gross profit. So basically, we are saying 936,950 minus 150,600, and then you get a figure of 786. 786,350. And of course, you have to underline there to show that you have made a calculation. So this is what we have. Then after that now, we also need to go to the section of other income, of which we have to add the figure that we will get for other income. So we are saying here we have other income. And obviously the total for other income should come here, but we need to list the other income that we have in the question. So we go to our pre-adjustment trial balance. And obviously under the nominal account section, that's where we're going to find our other income. So we go through each and every item that we're given there to check if we've got other income that we have there. So you see that we've got discount receipts here. We have our discount receipts, which is here, with an amount of 7,700. So we can go and put that one. And obviously, you need also to check if you've got any item, any adjustment that is affecting our discount receipt. If you have it, you have to adjust it, but if you don't have it, you just put the figure that you're given there. Discount receipt of 7,700, so you can put it in this column. Then we try to see if you've got any other income that we have. After discount received, so you see that we've got bad debts recovered also is an income on the credit side of 1,850 is our bad debts are recovered. So we've got bad debts recovered 1,850. So here we are saying our bad debts recovered. And then the figure that we are using there is 1,850. So this is what we get. Then we try to see again to check for other incomes that we can have in the question, but we see that discount, I mean, bad debt recovered becomes the last item that we have. So it's, of course, if you are not, if you finished our elements that we have in the other non-account section, it means also there are items that you have to check from additional information. Remember, we've got the issue of bad debts adjustments, provision for bad debts adjustment. So we can check for one provision for bad debts adjustment. Remember, if you have got a decrease of provision for bad debts adjustment, we should put it under other income. But if it's an increase, it's an expense, it's under operating expenses. So we have to check it before you leave the other income section, so that if it's a decrease, you can put it under other income. And also, you also check for trading stock surplus. So for trading stock surplus, remember, it can be a deficit. So you need to check it before you leave the other income section. So if it's a surplus, you have to put it under the income. If it's a deficit, you put it under expenses. So those two items, you need to try to see them before you leave the other income section. So also, if there is any disposal in terms of non-current assets, any non-current asset that was sold, you need to check if there's a profit on disposal. If there's a profit on disposal, you put it under income. But if there's a loss, you have to put it under expenses. So some of the items that we have to check before you leave other income section. So let's try by checking the provision for bad debts adjustment. So we go to additional information to see what the rate is being used to calculate, or are you given it as a calculated figure. So here we see that we have got item 5, which is adjust item 5. Adjust the provision for bad debts to 5% of current debtors. So But on top of this information, we also have a write off a further amount as irrecoverable 700, which means this is also a additional bad debt, which was not captured in the period. So first of all, we have to subtract 700 from the data's control because it was not written off. So you need to write it off. So by writing it off, you're subtracting it from the balance of data's control or data that are given in the pre-adjustment trial. Then you get a net figure. So that net figure is the one that we are going to use to calculate using 5%. So we go there, we subtract 700 from the data's figure that we are given there. We see that we have got data's control 38,700. So we are saying 38,700 minus 700 of further bad debts, and then you get a net figure. Then you multiply by the percentage that you are given is 5%. So basically, we are saying we are just giving a calculation by saying 5%, which is 5 over 100. We multiply it by saying the figure for data that we have 38,700, whereas the 700 for further bad debts that are going to be written off. So it becomes 0.055% as a decimal times 38,000 there. We try to see what exactly do we get there. So you say 0.05, then you multiply by 38,000. And you're going to get your 1,900. So it means we have got 1,900 as the level of provision for bad debts for the current period. Then you compare it with the previous period, which you are given in the list of balances as our provision for bad debts, which is here. So let's just try to see the amount that is there. We have provision for bad debts, which we have got 280. So it means there is a movement there from 208 from 280 to 1,900, which is an increase. So there is an increase. So if it's an increase, you have to put it under expenses. So it's an increase of 1,900 minus 280. So I will say that we have got minus 280. And we are going to get your 1,620. So you've got 1,620, which we are going to put under operating and expenses. So we leave it and adjust it when you reach the operating expense section. So we also check for trading stock surplus. So for trading, to calculate your trading stock surplus, we are saying trading stock surplus or deficit, you say your book value minus, you can just maybe try to minus your physical stock count figure. And basically your book value, you get it in the list of balances, whereby you are saying trading stock figure, we have it here, and it's 78,750. And then you subtract the physical. So before you subtract, you also check in the chart information if you got any adjustment that is affecting your book value. You go to additional information to check that there might be some adjustment that affecting your book value, but see that there's nothing. So it means you can straight away subtract your trading stock count, which is the physical stock count figure here, which is 79,100. So we come here, we are saying 79,100. Okay, just maybe try to cross check 79,100. So we subtract there by saying 78,750. 78,750, and then you subtract 79,100. 350. So 350 there, you are getting it as a negative 350. So if you get it as a negative, it becomes a surplus. And if it's a positive, it's a deficit. So in this case, it's a negative, which means our physical stock count figure is greater than our book value, which indicates a surplus. So we are going to put it under other income section. So we go there. And now we are saying trading stock surplus. So we are saying trading stock surplus. And we can just show the working, whereby we are saying, maybe we can just refer back, let's check the working, whereby we are saying 78,750, 78,750 minus 79,100. Minus 79,100, which is our total figure. So we calculate there, I will see that the figure that we are getting there is our trading stock surplus. You are going to get your 350. So you've got 350. And then we try to see we have exhausted all the other incomes that we have according to the question. So we can be able to add now the total of other income, whereby we are saying 350 plus 1,850 plus 7,700. Then we get the total, which is going to come here is our 9,900. So we are saying 9,900. So that's what we have. Then we can try to go to the next section, which is now the less operating expenses section. So before you go to your operating expense section, remember you have to say gross profit plus your other income, gross profit plus your other income, and then you are going to get your gross income for the year. So if you add the two, the answer is supposed to come here is 796,250. 796,250. And the description here we are saying is gross income for the year. So we are saying gross income for the year. So after that, now that's when we are going to have your operating expenses. So we are going to subtract it. So we can say less operating expenses. So we're going to list them, the operating expenses that we have. So operating expenses that we have, we go to our nominal account section and try to go down to see if what operating expenses are we having. So we can try to go to. So other than the account section, go down checking for those operating expenses. So you see that the first one that we have is here is carriage on sales. So we are here, we've got carriage on sales, and then we've got 22,620. 22,620. So you need to go to extra information again to check if you've got any adjustment that is affecting our carriage on sales. There might be some prepayments, or there might be some accruals that we need to adjust before we put that figure. But according to this question, so you can take our 22,620 as it is and transfer it to our income statement. So you're saying carriage on sales. And the figure that we have is 22,620. Then we go back again to check what else do we have in terms of our operating expenses. We have got our debtors, allowances, we have adjusted for that, carriage on sales, and then we've got bank charges now, under carriage on sales, which is 1,750. And of course, you need to go again to extra information to check any adjustments before you take the figure. But according to this person, we do not have any adjustment affecting our bank charges. So we take the 1,750. And then we can try to go back to see what else other bank charges. So after bank charges, we have got bad debts, 445. But if you go to additional information, you've got something which is on item 4, right? Of a further amount is irrecoverable 700. So we're going to say 700 plus 445. So we are saying So we're saying 445 plus 700. And then the total becomes 1,145. Then we go again to check what else do we have. So under bad debts, we've got stationery, which is 8,360. But this represents stationery that was purchased. So we need to see if the stationery that remained there at the end of the period. If you've got stationery at the end of the period, we have to subtract it from this figure to get the one that was used. So if you go to additional information, you see that according to stock at the end of the period, we don't have stationery. So you have zero stationery at the end of the period. But if you go to the item 1, you've got the owner took 50 rand worth of stationery for his son, but this was not recorded in the books. So if something is taken for personal use, like taken for his son in this case, it's for personal use, so it becomes on drawings. So we are going to subtract this 50 from the figure that we have for stationery, which is 8,360, and then we get the figure of stationery that was used. So we come in. We assign stationery. Thereby in brackets also we can show the working by saying 8,360 minus 50. And then we're going to get 8,310. Right. So after that, we also check after stationery what we have. We've got insurance, which is 27,400. So for insurance, we go and check insurance information, anything affecting our insurance. You'd see that insurance, we try to go down checking if we have got anything. The last item, item 10, we can try to go to item 10. Saying insurance included an amount of 400 which was payable for March 2014. And we know that our year is ending. Our year is ending February 2014. So this one is there was an insurance amount of 400, which was not for this period, which was for the following period, because March 2014 is for the following period. Our recent period is ending end of February 2014. So in other words, we are saying we have got 400, which was prepaid, which coming as a payment in advance, which you need to subtract. So we subtract 400 from the figure that we are having here for insurance, which is 27,400. So we just go and indicate that working for insurance. So we are saying insurance. We are saying insurance, and we are saying 27,400. And we are subtracting 400. And then we get to 27,000. Then I'll try to see again after insurance what do we have. We've got telephone, which is 19,480. So you try to check its information, you see that there's nothing that is affecting our telephone. So you take it as 480. So remember, before you answer the question, you would have gone through all the additional information. So as you are going through these balances, you can quickly pick that you have encountered an adjustment of that item, then you can refer. So that's the importance of going through additional information before you start to answer the question. So that when you come here on the nominal account section, you can easily recall that there is an adjustment that is affecting, for example, our insurance, then you straight away go there and adjust. So for telephone, you know that if there's a query, you go there and refer and see is there an adjustment or not. So in terms of our telephone, we do not have any adjustment. So we're taking 19,480 as it is. So we are saying our telephone telephone, we've got 19,480. And then we go there and try to see after telephone, we've got rent expense, which is 92,000. Rent expense. But you don't take the 19,000 as it is. You go to your information, there's something that is affecting our rent, so you can try to identify that. We come here, you see that on item 3, it reads on 1 March 2024, fashion designers acquired the warehouse SP a lease agreement. A rental of 4,000 rand per annum, per month was agreed upon, and then the rate was increased by 10% on 1 January 2014, and just the rent payable accordingly. So it means we've got rent payable, it means we've got outstanding rent that we need to address. So we need to find out what was the rent which was supposed to pay. To be paid. Remember, in the trade adjustment trade balance, we are given the amount that was paid. So what was supposed to be paid, we need to know it so that we can able to see the amount that was payable. So we can now calculate it. Given that information, we can be able to calculate it. So we are saying this renting was of the way I was started on 1 March 2012, which was way before our year started. Our year started 1 March 2013. So 1 March 2012 was way before. So it's not going to affect our calculation. So we are saying they agreed 12,000 per month, but it was increased 1 January 2014, which means January and February. That's when it was increased, January and February, which is 2 months. So it was increased for 2 months. So it means that 10 months, there was no increase. So we're saying 10 times, so 12,000 per month. Then we get the rent for 10 months. Then we are supposed to add after for the 2 months when it increased by 10%. Remember, it was 100%, and then it increased by 10% to become 110%, which is a decimal. If you divide by 100, if you say 110 divided by 100, you're going to get 1.1. So it means it was now 1.1 times 1.1 for after the increase. So you're saying it was now 12,000 times 1.1. Then we multiply by the 2 months that we have after the increase. Then you can now be able to find the total rent which was supposed to be paid. So let's just try to see. So we are seeing here we're seeing 10 times 2,000, then we're going to get to 120,000. And then you calculate there, whereby you are seeing your 12,000, you multiply by 1.1, and then you multiply by 2. You get 26,400. So you add the 26,400 plus 120,000. You get 146,400. 146,400. So this is what we have. So this is total rent that was supposed to be paid. But what was paid now, we go back to check what was paid for rent. So we have it there. What was paid for rent is 92,000. Rent expense 92,000. So having that now, we are saying what was paid is 92,000. So we can now be able to see what was not paid. So we are saying 146,400. 146,400 minus 92,000 to get what was not paid. So 146,400 minus 92,000. So we get 54,400. So it means 54,400 indicates what was not paid. So if you go to our instruction that is there, it is saying adjust the rent payable accordingly, which means you have to show the outstanding rent in your in brackets in the calculation part, whereby we are going to indicate it as 92,000 what was paid plus 54,400. You get the rent for the period, which is 146,400. So when you come here, we are saying the rent which is supposed to be for the period is 146,400. But in your calculation, you have to provide for the outstanding rent, whereby we are saying 92,000 plus 54,000, 54,400. So exactly as this. So this is what we have. So we can now be able to go to the next part of our expenses. So after rent, we have got our consumable stores, 550. So consumable stores, obviously, we treat it as our stationery, whereby we're saying 550 is indicating what was purchased for consumable stores. So to find the consumable stores used, we have to check at the end of the period if we've got consumable stores still remaining in stock, and then we subtract it from what was purchased to get what was used, which is the expense. So here we come here, you see that at the end of the period, we had consumable stores of 450. So we are saying we subtract 450 from 550. 450 minus 550 minus 450, then we get the figure for consumable stores, which is obviously going to be 100. So here we are saying consumable stores. Remember, you're saying 550 minus 450, and then you're going to get your 100. So this is what we have. But after that, consumable stores, take again what we have. We have discount received, it's an income. We've got salaries, 291,000. Salaries, 291,000. So we are saying salaries. But before we put the salaries, we also need to go to the information to check anything that is affecting our salaries. We have got salaries have been paid for 15 months. So it means it is salary that we're having in the P adjustment trial balance is for 15 months, which is we have got a salary figure of 291,000. So it's for 6 months. It's for 15 months, sorry. So 291,000 is for 15 months. So let's get the monthly one divided by 15. 291,000 divided by 15. I get 291,000 divided by 15. You get 19,400. Say 291,000 divided by 15. You get 19,400. But we know that in a financial period, we've got 12 months. So if you say 15 minus 12, you see that there is extra 3 months that was paid there for salaries. So what we have to see how much was the salaries for 3 months, then we subtract from 291, so that we remain with what belongs to this period. Remember, a prepayment or a payment in advance is supposed to be subtracted. So we say now 19,400 per month times 3 months. Get the total for the 3 months, and we're going to get 58,200. So we're going to subtract 58,200 from 291,000 for the which was paid to get the net for the period. So in brackets, we are saying 291,000, and then we subtract your 58,200. And then the other that you're supposed to get is 232,800. So this is what we have. And then having done that now, we try to see again in our pre-adjustment trial balance any further expenses that are given there. See that last one is bed covered, which is not part of our part of our expenses is an income. But if you still remember, we calculated a provision for bad debt adjustment. Here, when we're trying to see if it's an income or expense, we found out that it's 1,620. Here, we are not going to recalculate it. 1,620 is our provision for bad debt adjustment as an expense. And we found it by saying 1,900 minus 280. So we can go there. 1,900 minus 280. So also a provision for bad debt adjustment. Provision for. Of course, we need to show the calculation for that one. But the net figure that we got was 1,620. And we said 1,900. Let's just try to refer back to the calculation. It's 1,900 minus 280. 1,900 minus 280. And then we get to 1,600. 1,620. So this is our provision for bad debts. So if you go to additional information also, you would see that we also have the issue of depreciation, which is on item 6. Depreciation must be provided as follows: on equipment, 20% per annum on costs. And then we are told that a bar fridge was purchased for 9,500 on 1 December 2018. So first of all, we have to identify for how many months did we have this bar fridge. So we calculate that it was purchased on 1 December 2018, so it was there for December, January, and February. So it was there for 3 months. Remember, the year is ending end of February. So to calculate depreciation, when the rate is 20%, it's on costs, which means that we're using the straight line method or the cost method, whereby we say percentage times cost. So I'm just going to say 20% of 9,500. Then we get an annual depreciation. Then we are supposed to apportion it for the 3 months that we had that fridge, multiplied by 3/12. So basically, we are saying 9,500 9,500 times 20%, which is 0.2 as a decimal, multiplied by 3 months that were there for that fridge times 3/12. Let's calculate it like that. You're saying 9,500, and then we multiply by 0.2, and then we multiply by 3/12. Then we're going to get your 475. Means here we have your 475. So this is what we have. Then we also have equipment that was there for the way. Remember, 9,500, and then is one that was introduced during the year. But if you come to the list of balances in the pre-adjustment trial balance, you see that equipment figure that you are given. What is important for you to identify there is that the balance that are given in the pre-adjustment trial balance are given in 20 February 2014. This is pre-adjustment trial balance as at 20 February 2014, which means it was at the end of the year. So it means that 9,500 for the new equipment that came during the year, it's inside the cost for equipment that we have of 389,900. So we are going to remove 9,500 from 389,900, so that will remain with equipment that were there for the whole year. So we are saying 389. In other words, to calculate depreciation for equipment that was there for the whole year, we are going to say 0.2, which is 20% times in brackets 389,900. We subtract the 9,500 that came during 9,500 that came during the year. 9,500 that came during the year. So we calculate there. You're going to see that if you simplify it further, it's going to be 0.2 times 380,400. And the figure that you're going to get 76,080. Then you add the depreciation that we got for the 3 months was 9,000, which was 475. Remember, for the equipment that was introduced, during the year for 9,500 cost was then we calculate depreciation and then apportioned for the 3 months and got 475. So 475 to get total depreciation for equipment, which is going to be 76,555. So in brackets there, in the calculation of total depreciation, we are going to say total depreciation for equipment is 76,000. So here we are saying depreciation. And we're saying brackets 76,000. 76,555. And then we also have another non-current asset that we have, and there we can refer back. Another non-current asset is vehicles. Vehicle is 50% per annum according to the diminishing balance method. 15%. So we go there and we try to calculate using the diminishing balance method. So basically, we try to so we are saying using the diminishing balance method, we are saying the formula is going to be percentage times carrying value, whereby you have to first find carrying value by saying cost minus accumulated depreciation. So we have to find carrying value first. So the cost of the vehicles, we get it in the pre-adjustment trial balance, whereby we are saying the cost of the vehicle is here, which is 505,400 here. And we are saying 505,400 is our cost. 505,500. We can just maybe try to cross-check the figures. We have our 505,400. Then you subtract the accumulated depreciation. So check again the figure for accumulated depreciation of vehicles, which is which is 95,500. 95,500. Then we get your figure as 505,400, and then you subtract 95,500. And then you are going to get your figure is 409,900. 409,900. So this is your carrying value, and then you multiply by the rate of depreciation, which you are given as 15% here. So here we say times 15%. So 50% is 15 over 100. You multiply by 409,900. Then obviously the answer that we are going to get it's going to be 61,485. So we have got 61,485 is depreciation for our vehicles. So we go and add it now in the income statement to the depreciation for equipment. So here we are saying plus 61,185, and then we get a total of 138 and 40. So this is the end. But we still have interest on loan. We still have interest on loan to calculate, so we can just say interest. So for interest on loan, we go to the information to check what is it saying. We agree that a loan agreement with Metro Bank was signed on 1 October 2024 at an initial rate of 16% per annum. Metro Bank increased the rate by 2% on 30 November 2013. So the first thing is to identify the number of months when the rate was increased by 2%. And we have said that it was increased 30 November, which is end of November. So we are saying December, January, and February, 3 months, it was increased, and it was now 16% plus 2%, which is 18%. So we are going to calculate interest on loan before the increase, it was 12 minus 3, which is 9 months. And then after the increase, it was 3 months. So we are just going to go there and take the figure for loan that we have, and then we make a calculation and make a proportion in terms of the months. We come here, we are saying, and what the loan figure that is there. We have our loan figure, so we can just try to. So we are saying we are saying the loan figure that we have here, and we check the amount, which is 45,000 is the loan amount, and 18% is after the increase. Before the increase, it was 16%. So 45,000, we use before the increase, it was 16%, which is 0.16 as a decimal. We multiply by 45,000, and we know that we had 9 months, which is 9 over 12, before the increase. So we are saying 0.16 times 45,000, and then we make a proportion of 9 months. We get 5,400. So we got 5,400. And then we get, after the increase, it was 18%, which is 0.18 as a decimal, times 45,000 times 3 over 12. So basically, we are saying 0.18 times 45,000, and then we multiply by 3 over 12. We're going to get 2,025. So we add the two to get the total interest on loan. We are now adding 5,400. And obviously, we are going to get 7,425. Is our total interest on loan. So basically, we are saying the interest on loan in brackets, we are going to show a calculation of 5,400, and then it's 2,025. So we go there and make that adjustment. So we are here. We are seeing our interest on loan in brackets. We are saying 5,400. It was before it increased, then after it increased, we've got 2,025. Then we add the two. We get a total of 7,425. So we have finished our expenses. We can close whereby we close there. Right, and then we go there and we close at the top. Then here we close again, whereby we're saying we are adding everything that is in the box to get our total expenses, and just to come here is our total expenses figure. So we can just maybe try to add there to get our total expenses figure. We can just put a proper line by saying. So if you add there, you see that the total that you are supposed to get for total operating expenses is going to be 606,000. Let's see. Yes, 606,690. And we are going to subtract it from the figure for gross income for there. So we are going to say now 796,000 is gross, 796,250 is gross income for the year, minus 606,690, which is our operating expenses. We are supposed to get now your net profit for the year. So if you come subtract correctly there, the net profit for the year will be our 189,560. 189,560, which is our final figure in the income statement, and becomes net profit. Net profit for the year. So this is what we have as our final figure that we have in the income statement. So thank you for listening. Those who have subscribed, please subscribe and share. Let's share the link to our colleagues who are doing financial accounting info. Let's meet in that again in the next video. More typical examination questions are going to come as we prepare for the exam. Let's get notified. As for this video, I'm signing out. We'll meet again in the next video.